Hello and good morning to everyone. It's Tim Davis coming to you guys with a midweek market review. Not only is it, I'm going to be calling this a midweek market review, but today is March the 1st, 2023, March the 1st, 2023. It is very early in the morning. Figured I would pop in here to do a very quick market review after we ended the month of February. And I want to point out something that I mentioned about the month of February and how the month of February could shape up how this next quarter shakes out as we head into a new quarter and as we head into another part of the year. I think we're going to start to really see the bulls be tested in a major way. And I think the bears may be in the driver's seat right now. So here is a look at the SPXA 200R, which is a tool that you guys who follow me know that I normally watch, which tracks the percentage of S&P 500 companies trading above their 200-day moving average. And since we've been in this bear market, we've almost, not a full circle, but we've almost seen price action or even these percentages of stocks trading above the 200-day moving average revert back to an area where it broke down from before. And you'll see this almost perfect V pattern here. So here was the ultimate strong level when we had almost 100% stocks trading above the 200-day moving average. And that we reached that peak back in 20. And it is a monthly chart too, folks. Just point that out. This is a monthly chart. I want to show you guys what the bigger picture looks like first, and then we'll take a look at some shorter term time frames by looking at the SPX. S&P 500 and the SPY, which is the S&P ETF. Look at that here in a second. But I want to point out what the bigger, broader picture looks like as we head into March. So we reached this peak of about 97% of the S&P 500 companies trading above their 200-day moving average. Normally, when you see that level, normally that is almost an extreme high, and normally you'll start to see the participation of stocks above that 200-day moving average start to dwindle from that point, which is what we've seen starting in the beginning or the around the middle after the first quarter of 2021. Then we've seen a sell-off, and then only once you get around the close to the 50% or just above the 50% level, right around the 50 to 60%, normally you see some type of consolidation for a continuation to the downside. Then we got down to almost zero, not quite to zero. He ricocheted back up. Where to? Back up to that same level that we consolidated at before. Oh, I got markers going everywhere. So back up to that same level that we consolidated at before. And what happens? Not only do we not, have a strong break above this level, which would make it a strong case for the bulls, but we see almost a sharp reversal pattern. So the month of February showed a strong push, but then all of a sudden the bears fought back as we got close to the end of February, and bears fought back, turned this candle to a red candle with a long shadow above. That's normally some type of sign of a possible reversal after a push in the opposite direction. So it looks like we are starting a reversal. So we could see that this percentage really starts to dwindle as we go into the March, April, May. We got to see what pans out, but we could be heading back down to test the ultimate level back down here. So that's what the percentage of S&P 500 companies look like. So start to pay very close attention to Pacific stocks and ones that had huge rallies. We're probably going to start to see some struggle here as we head into March and April. So that's something to pay close attention to, is that ultimately the overall outlook of the health of the market. This is like a market gauge. This tool uses it as a market gauge or market sentiment as to how the overall market participation is about to show itself. So again, it's like we are right at a level of resistance, and this percentage of S&P 500 companies trading above the 200-day moving average, and could be setting up for a reversal at this point. So market sentiment is starting to look more and more bearish than bullish. Now, let's break this down and switch to a monthly chart of the S&P 500. So what I pointed out before is that it looks like the S&P 500 is well, the overall market's like it's coming to a head. So this range in here has been a very, very tight range over the past year. So over the past year, this has been considered to be a tight range. We have been pretty much range bound, in this range for the bulk of 2022. And now as we head into 2023, we have still continued to bump our head up against this strong level of resistance. And as you see over the past several months, we came back down to the bottom of this range. That's around about October. And then we just continue to march our way back up, up, up. But as you can see, price action continued to get, tighter and tighter and tighter, not being able to really show a strong breakout above the ultimate level of resistance. So it looks like price action is being compressed since October. And I believe that this compression is about to resolve itself. I really don't think we're going to break out to the upside in a major way and start a new bull market. I think this bear market is going to really start to show its ugly teeth. And I think we're going to start to head back down. I think the S&P should start to fizzle out here shortly, and we'll probably break this level of support here. If you look at the stochastics, looks like we could be possibly starting to fizzle out. In other words, starting to lose its steam. So we have to see how that pans out over the next several months. But it looks like this area up here looks like a super strong level of resistance that I don't think that the markets are going to be, it's going to be easily broken. So I think that the bears may win this battle here over the next couple of months. It may start to lose steam and start to head back down. Since we had a nice bounce from October, I think that bounce is about to be fizzled out. So let's pay close attention to that as we continue to try to battle this level of resistance here. And bulls have had a nice run from October up until now, up until February. And I think now at the end of February was a strong case for the bears, as we had a red month. So February was a red month with a long shadow above that body of that candle could represent that the bears are starting to take control. So I wanted to point that out there. And now let's take another look from a different perspective. I've taken a look at a weekly chart on the SPX. And as you can see here, the weekly chart is really starting to challenge this October ascending level of support. Looks like we're about to break right there. So again, looks like the bears are really starting to put the pressure on the bulls. And really, February was the ultimate eye-opener that we could be about to trend lower and head back down to this range here. So for all you bullish folks, just be careful, be mindful that we are still in a bear market, and that the bounce off of the October lows could be just that, a long-term bear market rally right up to a level of strong resistance. So this level up here was typically a very, very strong level of resistance. So the bulls could be about to be challenged in a strong and major way. The bears may end up winning this battle. First part, as we head into the second quarter of 2023. ETF that I like to trade when it looks like to me there's going to be some longer term downside in the overall markets, especially the S&P 500, is the SPY, which is SPY, SPY ETF for the S&P 500. So I have been taken on a longer term position, not even longer term position, but a SPY put spread that I've been in now for probably about, I guess, about a couple of weeks, and it's starting to really shape up the way I thought price action was going to shape up. So what I was looking for is see this SPY probably over the next 2 months or so start to really break down below 390, and I think we could be heading for price action below 390 on the SPY ETF. One range that I'm really focusing on, if you look at break this down to a daily chart, is that there's a tight range right at this level of support, and this is diagonal level of support, triangle level support, that we see price action kind of like consolidated right here. It was back in December, from these like the middle of December to about the first week of January. I think this level is going to be a level of consolidation that we can start to see price action pull back to. And the top of this range is right around 390, and the bottom of this range is right around 375. So I do think price action and the SPY could see the SPY drop back down to this range. Right now, SPY is trading around 396. So I do think we'll come back down to this range and possibly start to consolidate as well. So look out for that as S&P 500 continues to pull back. We could drop in that range, and then we got to see what happens. But I think ultimately, over the next several months, we could possibly see this range. If we do drop back to this, 375 to 390 range in the SPY, I do think eventually, as we head into the middle part of this year, that we can see this range broken even, and then S&P go even lower. So let's see how that pans out. Let's look at the SPX. Take a look at the Dow Jones Industrial Average, because this was really showing that the bears are really starting to show their teeth in the Dow Jones. Look at a monthly chart. I'm gonna show something, and I'm gonna look at a weekly chart. I'm gonna show you guys something. Looks like Hangman, a case of Hangman in the Dow. A strong rally off the October lows, but since then, again, right back up to a level of resistance, and unable. I mean, this is strong. You see, that's a strong level of resistance. Back up to the level, and what happens? We were stuck in this range for the past several months. Back up to that range, stuck in that range, unable to break above that level of resistance. And look at the month of February. That candle is a strong red candle for the month of February, and with little to no upper shadow. So I can highlight that. Little to no upper shadow. So that's very encouraging for the bears and very disappointing for the bulls. See that strong red candle in February with little to no upper shadow, with the oscillators and the full stochastics starting to agree with price action. We're starting to tip lower. It's starting to like it's ready to bend lower, and the full stochastics also in the Williams percentage starting to bend lower. And in the CCI, between the K and the D lines of the oscillating lines, they're starting to get closer. The green and the yellow starting to get very close to each other. It's like we're starting to pivot lower there too as well. So again, nice case of Hangman action. And looks like the bears are about to win this battle, pushing price action lower in February. So watch out below for the Dow. I think we're definitely going to possibly make a case for a possible retest of the October lows. Now, 2023 is going to be very tricky. because if for some reason we do come back down here to test these October lows, I want you guys to see where this will put us at again, right back to a threat. October lows there, right back to a threat of a breakdown below the highs of 2020. I've been harping on that for a while. If we break that back down below this level, below the highs of 2020, can't draw a straight line, but you guys get the point. I want to show how important this level is for the bulls. This is a very, very important level for the bulls. For some reason, price action comes back down to test this level and fail. The bear is really going to really accelerate itself if that happens. And we could start to see this range of the markets be tested, which means an ultimate possible test of the 2020 lows. Is that a possibility? Anything is possible. So this resistance level here of the October lows is going to be very, very crucial for the bulls to hold that line. If the bulls cannot hold this line in the midst of a possible pullback that we could be about to see, things can get really ugly as we continue through 2023. So that's something to pay close attention to, folks. Pay close attention to the October lows, which is pretty much essential, almost lines up perfectly with the highs of 2020 for the Dow Jones on a monthly chart. So that is a key level that we need to pay close attention to. Okay, let's take a look at the VIX. Because if the overall markets is starting to show some weakness, what is the VIX starting to show us? I'm going to take a look at the VIX futures, and we'll take a look at the regular VIX to show you guys what's happening. Now, this is a monthly chart of VIX futures. And it is looking more and more in favor of the bulls. This is a monthly chart. It looks like this is a strong level of support that you see me have marked down here. And it looks like the bulls in the VIX wants to hold this line. And if we look down below, the oscillators in the full stochastic range percentage and the CCI, they all look oversold on a monthly chart. So if we're looking oversold on a monthly chart, that is a very, very strong possibility that the VIX wants to make a major bounce. If you're looking oversold on a monthly chart, it wants to make a major bounce, and we could see that. Okay, you could see a major bounce from oversold conditions of the longer term volatility index. We take a look at the VIX, we'll see same thing, strong push off a level of support. And I highlighted this, I want to say in one of my past videos, that this was a range that if the VIX came down to this range, and if it held this range, we could start to see a strong reversal, a backup in the VIX. And that is what is starting to happen. Look at this possible reversal candle that we're seeing back in January. Back in February. Now we're starting to see, back in January. This is the month of January, and this is February. Starting to see that this test of this lower part of this range, it held perfectly. And we're starting to bounce out of this range from a level of oversold. And look at the full stochastics on the monthly chart. Everything looks like it's ready to reverse back to the upside. Here's a weekly chart. Temporarily, it looks like we reached a point where as the VIX this week starting to see that the bears are fighting back, or should I say the bulls are fighting back, trying to push price action back down. But I don't think we're heading back down to this range. I think we are out of this range, and we're going to start to really see the VIX possibly start to continue its move to the upside over the next couple of months. We pay close attention to that. And if we break out to an overbought level on the weekly and the monthly charts, we can really start to see the VIX really take off in a major way. So that's a look at what the overall markets are showing us, folks. It looks like we're definitely possibly in the midst of a reversal of price action in overall markets, where we start to probably see the bears really raise its head, and start to put pressure on the overall markets. So pay close attention to that as we continue to head into the beginning of a new month. Looks like we are starting to see that the momentum to the upside is starting to really be tested and starting to lose its steam. It's starting to lose the steam. These rallies are becoming more and more short, which was showing me that is a possibility that we're about to see a real breakdown. Now, one thing that I found interesting, if you're looking for a bullish trade, look at the natural gas has been sold off in a big way. But it's like a reversal pattern is setting up from a bearish to bullish reversal in natural gas. And that kind of like sparked my curiosity. And it got me paying attention to, possible good bullish setup. So it looks like the natural gas is starting to hit a level of support, and it's like a possible strong level of support. So this looks like a possible level of support right here for natural gas. You can start to see natural gas start to pivot. It got up to as high as, believe it or not, folks, $10 for natural gas back in around 2022, and it sold off drastically. So with a drastic sell off like that over the past year or so, like we possibly hit a level of support. So that's something to consider, take a look at. And I'm gonna show you guys some ETFs that are possibly easy to trade for those folks who would like to take a bite of this action without trying to trade futures. Like myself, I don't trade futures. I just use it as a gauge. Look at the monthly chart here. And you'll see that the month of February, you see, well, it looks like a perfect reversal pattern. Strong sell-off. It's like a perfect reversal pattern setting up. Oversold in the CCI, oversold in the wins percentage, oversold in the full stochastics. It looks like we are definitely seeing a possible pivot in the opposite direction. So that's something to pay close attention to if you're interested in possibly taking advantage of a possible reversal in natural gas to the upside. That perfect reversal. Oh, let me get rid of all this. That's a monthly chart. Here's get rid of that. So it's a monthly chart on the right, my weekly chart here in the middle. And it looks like we are possibly heading for a possible reversal back up to the upside. I'm going to see what happens. If you look at the weekly chart, drop well below its 200-day moving average, which is this red line here in the middle, in my upper middle chart. Let's see a move at least back up to about $4. That is a possibility, folks. Back up to close to that $4 level. Right around here, we're probably running to, let me expand this back out. So if the natural gas starts to accelerate in a big way, we could see at least back up around this level here for the first level of resistance. Just below $4, right around $4, we could see snapback rally to that level. Then we'll see what happens after that. We could continue to rally in a big way. So that is a possibility. One thing that I saw setting up, the UNG is a natural gas ETF. I saw some, probably not gonna be a sit now, but there was some unusual option activity that was popping up. A lot of bulls were possibly setting up in this ETF. I don't think I'm gonna see it this morning since no, I'm gonna see it this morning, but there was a lot of activity on the call side dealing with this ETF here. 1 second. So there was one ETF that was showing some possible bullish activity on this past week. Also another one, BOIL, which is also a ETF that tracks natural gas. It was also showing some crazy, unusual option call option activity on this over the past day or two. And I indeed did pick up a bull spread in BOIL. So food for thought. Natural gas could be a possibly winner to the upside, and the overall markets could be on the verge of a decent breakdown over the next couple of months. So, all right, folks, wanted to drop in here and give you guys that quick update, midweek update, and the end of February market review. Hopefully this is some news you can use until the next video. Tim Davis signing off. Enjoy the rest of your day and enjoy the rest of your week, folks.